Welcome back, guys. This is Justin Smith. This is the Investments YouTube channel. And today we have an episode in regards to the word indexing. My favorite strategy is called indexing. Indexing is a strategy and there are a lot of different products. There's also a big percentage of indexing products that are just worthless, but there's that small percentage that are great for people like you and me. And here's a secret. Your financial advisor may not know how to use these properly. What I need you to understand is indexing has the power to help you not lose in downturn markets or when the economy goes down, like today. In the multi-trillion-dollar insurance industry, which is also considered the backbone of America, shit, even the world, these large insurance companies that I'm going to use, for example, even one handles over $2.5 trillion. Like, could you even imagine handling over $2.5 trillion? That's like the amount of money the IRS collects in taxes each year. That's one insurance company. These insurance companies have been around well over 150 years, and they've made it through things just like the Great Depression. I mean, think about how many banks went under during the Great Depression, and the insurance companies kept on going. It's like running the 4x4. And you know when someone takes out fast, you know they're going to slow down. But that person that's in the middle, maybe even in the end, keep on going. Keep on going. Keep on going. They catch you, hawk you, and it's over with. And that monkey hump on your back, when that monkey hump on your back, when you're running that 4x4, you keep on trucking. Keep on trucking. And that's like what these insurance companies are doing. Also, 40 to 60% of banks never even reopened after that. And then when it comes to real estate, nearly 80% dropped during the Great Depression. Legal reserve insurance companies have to have reserves on hand for situations like the Great Depression. So this is why these companies are not going under, ever. Even over the last decade, numerous of reserve banks, legal reserve banks, went under, and not one insurance company went under. Could you imagine that? These insurance companies have what's called a general account portfolio yield. This means they have to tuck their money away in conservative investments like AAA and AA bonds. This means if they have to loan money to shopping malls or even skyscrapers, they can only loan about 60 to 70% of their reserves just in case there is a downturn in the market, so they can walk away clean, smelling like cucumber melon. Now, in the time that I've been in the financial service insurance industry, I've seen companies average anywhere between 7.5% to 8.5%. Now, this also means they need about 1% in interest because they still are in business to make money. But keep in mind, historically, the ranges have been from anywhere from 5 to 15%. Within the last 2 decades, we've been at around a 6% low interest. So let's use 6% for an example here. Now, many of these companies between the decade of 2000 and 2010 were earning about 6%. So this means that insurance company needs 1% for doing good work and because they're in the business to make money. So this means customers and clients are making anywhere between 5 and 6% after everything is paid out. Not bad. Now, if this is true and I want to out my money, let's say I worked all my life and I built up $1 million nest egg within these policies or within these contracts, and I'm ready to start taking funds out. And I say, just give me the net portfolio, general net portfolio interest rate. And they'll say it'll be 5%. That means they will pay me $50,000. And if I take it, it's tax-free. Don't forget that part. I don't have to report it on my tax returns. And if I wanted to sit in there in the cash value and let it compound, I can do that too. Even though we're currently in what's called a bear market right now, let's say I'm feeling bullish about America next year and I want to link my contract or link my policy to the index. Now, what is the index? You got the S&P 500, you got the Dow Jones, and you also have the Russell 2000. But let's choose one of my favorite indices, which is the S&P 500. So if I say I think the S&P is going to do good this year and the market's looking good, let's just say the S&P right now is at $1,000 and the next year it looks good as well and it jumps to $1,100. Now, with my $1 million nest egg, if that S&P jumped from $1,000 to $1,100, that means I also gained 10% in my $1 million nest egg, meaning I just grabbed $100K to either leave in my account compounding interest, or I can pull it out and put it into real estate, invest it somewhere else. Now, in order to accomplish this, what do? Like at any moment, you know, there could be a terrorist attack and the S&P can drop 40%. Not me, because I'm indexing, which means the indexing has a floor. Many of the, you know, in this decade or in that decade when there was terrorist attacks, a lot of people using indexings have been gaining anywhere from 16 to 17%. Now, those are the caps. Caps are usually 15%, but they're winning when the market is down. All that means is these indexers did not allow the insurance company to use one dime, $10,000, $1 million, or any of their money to be at risk in the market. These funds were tucked away safe in the insurance company, earning that national conservative 5%. This means what they relinquished was that 5% for sure. They got the for sure 5. Now, let's say with that $1 million in my contract or my account, they take out 5% and they use that 5% to play in options. Now, insurance companies are the #1 players of options. So they know the game. They're not going to lose. That's guaranteed another 5%. That's where that 5% came from in a down year. This means they have the capacity to pay whatever the S&P gains up to the cap of what, 12 to 15, 16%. This is because at any moment that 50K can jump up to what, 100K, or even jump up to another 50K, which is $150,000. But in order to play it safe, they only have the cap to play with. But don't forget, zero is your hero, meaning people had 5 years of consecutive losses and we didn't lose one dime. We wouldn't have lost one dime in the market. And of course, where there was 5 up years, I would have only gained up into the cap, which the average at that time was about 7.5%. I'll take 7.5% any day, knowing that I don't lose money when everyone's down. Now, there are some situations where you can raise that floor up to almost 2%, which ain't bad, but that brings the cap down to 13, maybe even 12%. Have you ever considered being your own bank or even taking back control of that banking function in your life? Get rid of the middleman. In the link below, my team and I have created a free ebook for you where it teaches you how to become your own banker while also mitigating the risk and taxes. My name is Justin Smith. This is the Investments YouTube channel, and we'll see you next video. Peace.